Hello and welcome to Fat Profit's special webinar called Sell in May and Go Away. Thank you for your company today. My name is Roger Malik, the Head of Client Services at Fat Profits. And joining me in today's webinar is our Senior Account Manager, Christopher Balafas. Chris, welcome to today's webinar. How are you
Hi,
today?
Roger. Yeah, good, Roger, and nice to see so many in the webinar today. Look forward to everyone's comments as well, and just bouncing back some of the points that we're going to show today.
Yeah, thank you, Chris. Yeah, looks like people are still coming in as we've started the webinar. I can see is about 285, 86 now.
Excellent.
And yeah, look, I'm sure people will keep coming through. So look, we've got a lot to talk about. And if you attended one of our recent webinars a couple of days ago, apologies, I think there was some technical issue there, but I think this should be fine. Hopefully no issues. But today, look, we've got a lot to go through, but the key message from us is, looking at sell in May and go away, looking at your portfolio. We are going to talk about the Reserve Bank in Australia, the Federal Reserve in the US. We are going to have a look at the regional bank issues in the US, the ASX 200, where it's going to go, the US markets. We're going to look at commodities, gold, lithium, many stocks, income, dividend stocks. I mean, you name it, we've got it today. So before we get started, let's do a bit of housekeeping. All our presentations from Fat Profits are general information only, including today's webinar. If you're looking for personal advice, then please see your financial planner. And also past performance is no indicator of future performance. Now, we'd like to make it interactive today. So if you have any questions, you can type them in on your screen, and we'll do our best to answer as many questions as we can. And given that we've got now more than 300 people actually right here, I'm sure there'll be enough questions for us to cover. But if there's more, you can always email them through. Now, before we start, I'm going to put up a question for you because we know that you're giving up some time today to look at Fat Profits' views on the market. You're obviously looking for something from this webinar. So what is that one thing that you're looking for? Is it market direction? Is it stock tips that you're targeting? Maybe you've got some cash, you're looking to buy one or two stocks, or you're just improving your knowledge of the markets, or maybe you're in the market looking for a research service and you've come across Fat Profits, or you may be a past member, you're just looking to see how we research the stock market and what's our performance like. So either way, let us know, and that would be great. Will give us some idea on what people are looking for. Okay, we've got quite a few responses, so I'm just going to close this now. Thank you for your feedback, and we are going to now move on. So let's get started. First thing first, sell in May and go away. And that's what says the RBA. It's just a bit of rhyming there. But look, this is the old saying, and why that is, here's some factual figures to prove that it's not just a saying, these are factual numbers. So if you look at the screen, this is the S&P 500 over a very long period of time, close to 50 years of data. And you will notice very clearly that May to October, the 6 months period, the markets are at the weakest point, only go up by 2% in a 6 months period. And clearly November to April, which we've just come off now, that 6 months period is the highest period in the US stock markets. And Australia is not an exception. We're going to show you Australia a bit later on. So what does that mean? Should you sell the whole portfolio? Should you just sit on cash? The answer is no. But should you lighten up? Should you be proactive in looking at your cash levels? Yes, that's certainly the answer that we suggest for you. Now let's move forward. We do expect that this bear market will come to an end, and we do think there is a new bull market in the works. We're not there yet, but it will come. And in anticipation for that, we are going to give you some advice today, general advice on what you may do in the coming months. But before that, let's have a quick look at Australia. So we know that in the Australian economy, recently the Reserve Bank have raised rates by 25 basis points, surprising pretty much most economists, most people out there, and they've raised by up to now 3.85%. Now, part of the reason for that is certainly the inflation numbers, which are now sitting at 7%. You can see that on the chart. They were as high as 7.8%, but now down to 7%. Even though they're forecasting that the inflation by the end of this year will drop to 4.75%, and it'll be close to 3% by mid-2025. So that's 2 years from today. They're still looking at a sizable inflation compared to the target of 2%. So that's part of the reason why they've raised rates again. They'll probably do it one more time, is the expectation in the market. Whether that happens in June or July, time will tell. But that's the situation at the moment. Now, on that note, Chris, over to you. The ASX 200, because as an investor, that's the main thing you're looking at is a market. We know that the markets have hit all-time highs a few times, but tell us more where we see the markets in the coming months.
Yeah, in the next slides, we'll show why we feel like there is going to be a further correction. But as Roger, you just mentioned, interest rates, again, surprising a lot of people. They're trying to control inflation. It'd be great to see inflation go down to those levels next year, Roger. But as we can see, there's a support level. So we feel, and we'll show you the reasons why, we feel that the ASX will drop to around the 6,400 level. That's where we feel like it would be a good time to start using our cash to get back into the markets. The markets are going to remain quite volatile, and as we're going to mention very soon, there will be potentially a mild recession coming in the US. So these support levels will be something to be watching.
Yeah, very good point there. So previously we've bounced off 6,400 twice. You can see that there. But also we're pointing out May last year. This is part of the theme today. You can notice that May last year, the markets were closer to the current price, and we saw what happened in May and then followed by June, and that's when we hit the 6,400 points. We're not saying that that's what's going to happen in May and June this time around, but certainly weakness is expected. There is some tax selling in June as well, but overall with the raising of rates, we are going to see some weakness in several sectors around the economy. So just something to keep an eye on, and we are watching this very carefully. Moving on to the US now, this is obviously the biggest economy in the world and certainly the biggest stock market in the world. They move everything else that happens, and we know that recently we've seen the banking jitters, and First Republic has now become the 4th regional bank in the US to be basically gone under. And they have been bought out by JP Morgan, which is the largest bank in US. Now, part of the reason, of course, is because they had bad decision making in terms of investing in long-term securities, and with rising rates, they were unable to use that to help shore up their deposits, because there's been a big outflow of deposits because the investors could sense that their balance sheets are actually in the wrong place. So that's causing issues in the regional banking sector. And inflation, we know in the US, is headline inflation has consolidated in the last 6 months from 9% down to 5%. So that's good news if you're an investor. But at the same time, the big issue is that the core inflation, which is the main thing that the Federal Reserve are looking at, which excludes your volatile food and energy component, that has remained pretty sticky around 5.6, 5.7% for the last 4 months. In fact, it's actually gone in the opposite direction to what they want. This is the big issue that really they're trying to solve. And here you'll notice in this particular chart, which is a very, very long-term chart from 1958 till now, so you can very well guess. And for some of you who may have lived through the 70s and would have seen core inflation skyrocket to 14% in the US, you might remember this. And post that, yeah, they've been able to get a hold of inflation, keep it down to that 2 to 3% target range. But you can see the new explosion in the last 12 months. It has gone up to 6% and higher. It has, yes, come down to 5.6%, but very slow in moving further, and has proven to be sticky. This is the problem. This is what they're trying to bring down quickly, but it's taking a lot longer than previously anticipated. Now, how does this compare to history? Because we know history really always teaches us a few lessons. Now, if we add the Federal Reserve rate to this chart, which is the orange line, that's the Federal Reserve cash rate. You'll notice in the 60s and the 70s, when core inflation went higher, Federal Reserve raised cash rates even higher than the core inflation to bring it down. Now, they've done it successfully throughout the late 60s, and they brought it down, but then it started going back up again. They raised the cash rate higher than inflation. It came down, but they started cutting. This is the one big mistake that they made. They cut interest rates very quickly, and they came under the inflation rate, and then inflation started rocketing back up again. And this is when Paul Volcker, the Fed chair at the time, he decided to crush inflation by raising rates to 19%, unheard of, never happened in history, 19% to bring 14% inflation down, and kept it there for years before inflation was finally crushed. But even then, they kept rates higher for a very, very long time. Now we see rates currently, fast forward to 2023, rates are still lower than inflation, and this is the problem. So Federal Reserve are really trying to get higher rates for longer and try to bring this inflation down. Otherwise, they risk what would happen in the 70s, and nobody wants that, and that's the problem. So hopefully you've learned a couple of things from this particular insight on history about inflation. Moving on to GDP. Now, this is how a technical recession is measured. If 2 quarters in a row you see negative GDP growth, that's a technical recession. We saw that earlier in 2022, as you can see on the chart, but that was very mild, and they potentially basically denied that there was a recession in place because all the other economic indicators were pretty positive. Since then, we have seen 3.2, 2.6, and now recently for Q1 2023, GDP was expected to be 2%. It actually came at only 1.1%, big drop. And the expectation now is that Q2 will probably be lower, but still positive. Q3 and Q4 is when really they're expecting a negative GDP, which means the recession. Talking about the recession, Chris, as you said earlier, the Federal Reserve for the first time have actually recently come out and they said they're expecting a mild recession by the end of this year. What are your thoughts?
Yeah, well, if you've been listening to Roger, all these 10%ers do point to the recession. So the Fed is really in a sticky situation, Roger, because as you showed, we've got the interest rates rising, we've got the inflation still very high, and this banking crisis, it's a bit like a band-aid over a broken bone. So it's certainly not over. So we can actually see the S&P dropping to a point that we feel it will hit another support level. Perfect slide. So it's actually come down from the highs of 4,800 on the S&P 500. It's bounced a couple of times, but our technical analysts feel like the support listeners, it's going to drop further to around the 3,200 levels, basically where we were just pre-COVID, which we saw the massive drop. So that's a support level. We're not saying that's the lowest it's going to go, but it does give us a great indicator that the volatility might be over around then, and that's when we're going to start drip feeding dollar cost averaging, getting back into the markets, Roger.
Yeah, very good point. So in fact, we just received a question from Karen, saying by when do you expect the sell-off in the US markets? So look, maybe I can answer that for you, Karen. Look, as Chris said, while we don't have a crystal ball to know the exact time frame, but we are expecting, and we're watching the space very closely, we are expecting in the second half of this year, probably around that Q3, Q4 time, is for the markets to finally give in, and as the recession bells start to ring in the US, that's when we're expecting the next sell-off. So until such time, we, advising our investor base to hold on to good levels of cash, which we're going to talk about in a moment. But if we get down to these 3,200, 3,300 point level, we'll be a lot more comfortable buying some good quality companies at very cheap prices. That's our plan, but we'll talk more about it in just a moment. Moving on to the S&P 500, you will also notice that one of the key things is that the breadth of the recent rally has been the lowest since 2005. And what that simply means is it's not spread across the whole index. It's only the top 10 companies which have pushed the whole index higher. If you take out those top 10, you know, you're looking at the other 490 companies, they're not in a very good shape. So if you just really had them performing, you'll be much worse levels today than ever before. So this is really a sign of, you know, the big companies really just performing, but everything else is not looking as healthy. Now, finally, if you look at a bear market, this is the third longest bear market in history. And if history teaches us a few lessons, you'll notice that the first phase and the second phase of a bear market is roughly around 20% drop, which is what we have seen around the world. Australia has actually done not as bad, but you certainly look at US and a few other economies. The third phase, which what we haven't seen yet, but we are expecting that in the second half of this year, that's the big sell-off. And on an average, it's 24%. And recently, you'll remember from 2020, that's featuring right at the bottom of this chart, 22% drop there. So that's when all the major shake-off happens. And that's pretty wild and pretty violent as well. So we're expecting that sometime this year. And some of the indicators which are really pointing to that is you look at the leading economic indicators and versus the GDP. So the blue line is the leading economic indicators. The red line is the GDP. Every single time, this is again going back to 1959, so every single time the GDP goes into negative and you see the leading economic indicators also drop in the negative, you have seen recession, which is these tall gray bars. That's a recession. And you see that every single time it has never failed. And now what are we seeing? The leading economic indicators pointing in the negative direction and still going further south. GDP still positive, but just, and if one does eventually become negative later this year, and the leading economic indicators also go down further, that's when we think will be a good time to be buying some stocks. Another important indicator is jobless claims, the unemployment benefits. This is a weekly chart, and this really shows that more and more people are filing for jobless claims and unemployment benefits. It's rising slowly, but surely it is rising, and we expect this to continue in the coming months. And another indicator that we'll look at here at Fat Profits is how do these initial jobless claims in the past have proven to be another indicator for a bearish market. And you notice every single time the initial jobless claims are coming off an absolute low and they're starting to rise, that's followed by a recession. Coming off a low, starting to rise, coming off a low, starting to rise. And you can notice where the mouse is every single time. They start to rise and then a recession happens. This is just systematic. And fast forward to today, they're coming off a low and they're now starting to rise. So this is, again, early indicator, something we look at Fat Profits. And final one for you today, before we move on to some stocks tips, is money market funds. Where is the cash going? Now, we don't sit here and wait for a bit of a gut feel. We look at actual indicators. So you can notice here on this particular chart, $5.1 trillion have moved out of the stock market, out of bank deposits, and moving into what we call is money market funds. And this is basically lots of your safe deposits like bonds, term deposits, etc. And every time that has happened, when you've seen a systematic rise in money market funds, you can see in 2007, 2008, that is usually before a recession. And only after a recession when you start to see money come out of money market funds and really come back in the stock market. And I can show you here on this particular chart a classic example. See the money market funds rise, recession in 2008. Once it's all done and dusted, money coming out of money market funds and straight into the stock market, decline after market bottom. Again, a big rise before 2020 and followed by a decline and money coming back in the stock market. Now we're seeing another rise, a big rise, still hasn't finished yet, 5.5 trillion at the moment and still rising. So keep an eye on this, and this is important. So on that note, Chris, another indicator is bond yields. Tell us a bit more about this, please.
Yeah, such a good indicator, Roger. Now, we might not be investing in bonds, you listeners, but it's still good to understand where we're going. So again, we're just trying to show our members, well, you listeners, where the markets are going. So this is the inverted bond yield curve, the lowest it's been since 1982. So every time, as you can see, we're just looking at indicators, what's happened in the past. Every time we've gone to, well, we've touched that 0 and below, we've entered the recession. So the bond yields just give us a good indication. I mean, 2008, when we had the GFC, we were in that recession for quite a while. But as you can see, just recently, when COVID hit, we just touched the bond yield just touched that 0 line. We entered a very, very small recession. The markets popped back, but as you can see, we're well below that support level, which is again indicating that there is a mild recession coming, Roger.
Yeah, absolutely. All these are pointing to one thing. And then the final thing for you today is the domestic banks. We know what's happening in the US with the regional banks having some issues, and they are going to tighten their lending standards for commercial and industrial loans. And every time they've tightened over 40% of the domestic banks, we have seen a recession. And you can see that again happening on a regular basis, 2000, 2008, 2020. They had to tighten, but now we're just at 40% and rising. So we're again pretty comfortable knowing that this is happening, and we're aware of this as an investor. So that's all the macro for today. Hopefully you gained some good insights there, and if you have, please let us know through your comments in the comment section. If you have any questions, let us know. But we're going to keep moving forward, because now we're going to look at a few sectors, both in ASX and also overseas. So starting with the financials. Now, we know that the regional financial index in the US is having trouble. 4 banks have collapsed. There's about 200 odd banks who have some weak balance sheets. There could be a couple more. We don't think it's going to be all across the board, but certainly the next 6 months will be very important to look at this. Now, this has come off 50%. So from $77 all the way down to $38. So this has dropped 50%. That is massive. Now, put that in context, look at the Australian financial index, pretty healthy. Haven't really seen a major drop, but you can very well imagine if we saw a 50% drop in the Australian financial index, I mean, that'll be catastrophic. But what are your thoughts, Chris, on our Australian banking sector, especially the big 4 banks?
Yeah, we're not comparing apples for apples with the American banks and the Australian banks, but yeah, look, we cover the 3. We like the banking sector, Roger. We cover 3 out of the 4 major banks. They've got tightly regulated positions of the banks. We actually cover a few others as well. Yeah, so we actually we've just got them on hold at the moment, and we will be updating our members at some point as to what to do. But we'll just reiterate the point, they're just on hold at the moment.
Yeah, absolutely. So within the financial sector, look, there's you can also look outside the big 4 banks, because look, for us, we're not here to just recommend the big 4 banks or Telstra or Woolworths. I mean, most investors know what to expect from these companies, so you don't need a fat profit to tell you that buy Telstra, for example, it's a defensive stock. But what we really specialize in is looking outside the norm, and Hub24 is a classic example. Now, how many of you watching this webinar today have heard of Hub24? How many of you have ever bought this stock? Now, you'll be surprised to know that this is the #1 platform for financial planners in Australia for 6 years in a row. It's been awarded, and they are a top 200 ASX company. They also manage funds, and you can notice that they manage very well because their financial health is very strong. You will also notice that their funds under administration for the last 5 years here has gone up consistently. They're managing billions of dollars of investor money. So this is a very strong looking company. But Chris, tell us more about when we first bought it, and how does an investor really benefit from holding a company like this for a long period?
Yeah, great example, Roger, of just looking at quality. So 10 years ago, as you can see, we bought them at a very low price, at $1.35. But just going on to what you were saying, they just had a very solid March quarter results. As you can see, they are touching or trading at premiums at the moment. So that's why we've moved the buy to a hold. But the analysts can see there's a lot of positivity coming ahead with Hub 24. In fact, when we sold half at, I think it was 2022 in June, we actually banked in 1,600%. So we just sold half. We had done some dollar cost averaging, as you can see. But when I speak to a lot of our members, Roger, just asking them how much they put into growth stocks. But if you just put in a measly $10,000 when we first recommended it, well, you can see what your results would have been. So we try to get in before the general public, and this has been a great example.
Yeah, well explained, Chris. And that's really the message for investors. If you're watching this webinar today, I'm sure you have one or two stocks in your portfolio which reflect some good numbers like this. That's really what you want, is a few more of those, and that's what makes the biggest difference at the end of the day. So getting in early, doing your research, having lots of patience, and that's the other message. Because you look at the first few years, the stock didn't move, and that happens. Some people panic and they say, oh, this is doing nothing, it's sell and move on. But you really got to have a lot of patience. You got to have conviction in your research and hold them for a long period. Another stock in the financial space is QBE. Now, some of you watching this right now probably might say, oh, hang on a sec, insurance company, no, not for me, right? Because people do think that insurance companies have very high risk because there's natural disasters, there is earthquakes, there's floods, there's all kinds of things going on. But I do want to let you know that that's not how you look at insurance companies. They have reinsurance in place for all of that. So that's the business model. So it's not like they're shocked when there is an earthquake, whether that's expected. They have reinsurance for that. But coming back to this, look, this is another good example of a solid top 200 company. They pay 5 to 6% dividends. And if you buy them at a good point, like we did many times in the last 2 years, $9, $11, $12, well, it's gone up 50% in 2 years. On top of that, you receive 5 to 6% dividends per year. Pretty healthy, and that's another stock out of the blue which you may have completely overlooked. But moving on to commodities now, that's a big part of Australian investing. And Chris, at Fat Profits, we specialize in commodities, and that's one area which makes us different than some of our competitors who are maybe not as strong with commodities. Now, one of the things we look at is certainly the strength and weakness of the greenback, the US dollar. And clearly you can see on this chart, US dollar had a phenomenal run last year. We hit close to record highs. But in the last 6 months, you've now seen money really coming out of the US dollar. They're sitting on a bit of support, but the expectation, tell us more, Chris, what's our expectation of the US dollar in the coming months and years, and how does that relate to other commodities?
Yeah, well, if you know me, you'd know that I love to talk about commodities and especially gold. But as we can see, the US dollar has been weakening. And again, just going back to those 10%ers, interest rates, inflation, recession, mild recession, we can see, and listeners, you don't need us to tell you that when the US dollar is weakening, people run to gold. And now we've been following gold since it was around 260 an ounce. Oh, a great chart. So we've been following it since it was 260 an ounce. And again, when you've got the US weakening, well, again, a lot of people are going to be running to gold. So the highs of gold are around 2,075 US an ounce. You can see the chart here at the moment. We touched that very recently, but once it actually is going to, once it does touch the 2,075, then we can see it actually continuing, Roger. So we can actually see a support level, resistance level of around 2,200 to 2,300 an ounce, which is going to do phenomenal if you're in the right gold stocks at the right time.
Yeah, well, that's the key. So holding gold is one thing, but holding good quality companies. One of them we can give you today as an example is Gold Road Resources, so GOR. Again, something which is not your typical traditional Newcrest mining stock, which is the biggest gold producer. These are the types where you can significantly outperform anything else in the market. Look at Gold Road Resources performance. Yes, it's not going to be a smooth line. It's going to be a bit choppy, but it will provide you some good returns. Look at when we first bought it, 35 cents, when they were a junior miner, but over the years they have struck gold, literally, and they have turned that into cash, and you can see they're now $1.83. So a 10,000 investment there would have turned into 45,000. Well, certainly would have paid for our service many times over. Just one good stock like that. Now they are in the second year of production. Going from here onwards as well, we expect Gold Road to hit new all-time highs, past $2 an ounce. Past $2 a share. And certainly, if you add $200 or $300 to the gold price today, and you add that in another few months, we know what's going to happen to Gold Road. We know what's going to happen to other gold stocks. They're going to be hitting all-time highs, and that's the value of long-term investing, buying early, and holding for a longer period. Now, Chris, some might have missed out on Gold Road, but we have another hidden gem in our portfolio right now. And while we can't give the name away for free, but this stock is looking very cheap at 16 cents. Tell us more about this.
Yeah, one of our high conviction buys at the moment. As you can see, we've been buying it over a considerable amount of time. Completely debt-free, a WA miner. We absolutely love this stock. Again, you're not going to put your firstborn into it, but it definitely is worth holding them. As I mentioned, they're completely debt-free, very cheap price at the moment, Roger. And in fact, they are very cheap gold excavators. So if you're digging out gold at a cheap price, and you've got the gold price around 2,000 US an ounce, and it goes to 2,300, your profit margins only increase as a business, and you're completely debt free. So we can see them going well past where they were last April at 45 cents. We can actually see them going further than that in the next 12 months. But again, we're going to talk about it. You got to be patient. Patience is definitely a key when it comes to investing, but a great hidden stock.
Yeah, well, this one, if you're interested in investing, they're keeping in mind this stock is already a producer, so they're not just an explorer. They are producing gold. They're turning into cash. They've also recently raised a lot of capital, and that's why the stock price has come down. But that's all behind them now. They've got plenty of money in the bank, so they're all guns blazing. So if you'd like to find out more, let us know. We're happy to share more information. Or if you want us to send you anything, or you might not be in the market for a junior gold producer, that's fine. Let us know your feedback, and we can provide you the appropriate information. Moving on now to other parts of mining, which we're also quite bullish on. Well, another stock is, you may have heard of this, and if you haven't, well, maybe you need to pay a little bit more attention to the commodities. Chalice Mining, easily the best stock on the ASX for the last couple of years. You'll see here it's gone from 12.5 cents, 17 cents when we first bought it, to the highest they've been is $10.50. That is phenomenal. It doesn't happen often, but when it does, boy, it looks amazing. Now, small 10,000 investing would have turned that into $640,000. No kidding. And look, it's not just fake money, it's real money for some people who genuinely invested and they're holding it. We know a lot of our investors who are still holding this stock. It did pull down back to around $3, but recently they've also had phenomenal results from their WA mine. It's now just about $8 again, so still rising, and one of our best performers for all time. Now, the final part of commodities to talk about today is lithium. Now, we all know what lithium is used for: electric car batteries and many others, mobiles, and many other similar assets. Now, lithium prices had a phenomenal run from 2021 to 2023. You can see that on the charts, absolutely gone up 6 times. So what happened to stocks, which of course they've had a phenomenal run as well. But now in the last 6 months, they have come down by more than 50%. Now, that is presenting some good opportunities for people who may have completely missed out. And one stock we can talk about today that you can add to your watch list is Allkem, AKE, Argentina-based mine, but they also have mines around the world. They are the 5th largest lithium producer in the world. Lots and lots of revenue, as you can see, $557 million of revenue in the last half of 2022. But also looking at the share price here, Chris, this stock has done very well for us and our members.
Yeah, and as you said, Roger, a little bit earlier, to the listeners, it's a stock to watch. But what a brilliant stock. Just think about May 2020, we were going through COVID. That's when we were recommending this stock at $1.70. It did hit the highs of 16, but we're around 12 at the moment. So just with the lithium price environment at the moment, the analysts have just remaining cautious. We just have moved it on a hold. But again, Roger, with the way the lithium prices are, it won't be long until we'll be advising our members when it's going to be a good time to actually get back in.
That's it. And that's what you look for as an investor, is when can I get in to these companies? And that's what we can provide you. Another one in the same space as lithium and nickel is IGO, who've got a huge portfolio of companies and mines underneath their parent company. And again, something we have bought around that 2020 June, July level. And look, again, for the first few months, that stock didn't do much. In fact, it even went down for a while. But you've got to, again, as we said earlier, you've got to hold, you've got to buy it a few times, dollar cost average. And look, boy, when it started running, it ran very hard, up to $16. Again, now recently it's come down a little bit, but no sweat. We'll hold and we'll be patient. So again, 10,000 invested would have turned into $42,000 by now. So these are the type of companies you can put them in your watch list. Now, Chris, one of the things we want to address today is, given that we are in a bear market and we are looking at planning and preparing for a new bull market, we need to have a plan, because people can't just sit there and go, well, we'll see what happens. Well, we've got a 4-point plan in place, and maybe you can run us through a couple of these key points, Chris.
Yeah, and as you mentioned earlier, if you fail to plan, you plan to fail. So with all these indicators, if you start seeing the markets drop, listeners, well, what do? Well, what did you do when COVID hit in 2020, when the markets dropped 30-40%? Probably nothing, because you were fearful, you didn't know what to buy. So what we're doing at the moment is we're telling our members to be patient. Actually, I love that fourth one, just staying patient, watch the markets, stay defensive. We look at keeping the risk at a minimum. If we can get an income along the way, then that's great. And raising cash, and we'll speak about it a little bit later. We've got quite a lot of our positions on hold. We've got a lot of cash, Roger, and avoid the, trying to make 1,000% returns in a week. It did happen with Chalice Gold in 16 months, but with this current environment, we're being very patient, we're in cash, and we're looking defensive.
Great, good points, Chris. So let's look at a few of these things. So stay defensive. Now, people might say, hang on, how do you stay defensive? So what can you do? So one of the things you can do is look at defensive companies with good, strong balance sheets, because that's what everyone wants in a bear market. So some examples right here on your screen, your big four banks, your Telstras, etc. So that's one way to do it. And one classic example of a stock that, again, you may or may never heard of is Spark New Zealand. So how many of you watching this webinar today have heard of this company? How many of you have invested in this company? I dare say not many. Now, this is an equivalent to the Telstra of Australia. So their Spark New Zealand is a New Zealand telco. So they're quite a big telco in New Zealand. And you can notice here the very, very strong trend. A little bit up and down, but generally very strong uptrend for the last 10 years. The stock has more than doubled in these 10 years. They pay a very good dividend of 5 to 6% a year. So if you just collect your money 5 to 6% every year and your stock doubles in 10 years, well, that's a classic defensive stock. And you can't really go wrong with these type of stocks. So that's one. Currently it's a hold, so we're not buying it just yet, but we may turn that into a buy when the market presents these opportunities. So that's one example of defensive stock. But cashing yourself up, that's really what we are focusing on as well. So Chris, talking about cash, in fact, let me pull up a question here first, because I want to ask the audience today to see how much cash people are sitting on, just to gauge what people's thoughts are. Now, some of you might be on less than 10%. Well, something for you to consider, and we'll provide you our input in a moment. And if you're at different levels, just let us know, and we will provide our input. So while people are doing that, Chris, can you tell us what sort of cash level at Fat Profits and our CEO, Angus, what are we sitting on?
It's funny to see some of the results coming in, Roger. But yeah, Angus, and there's a slide that we'll show very soon. Back in September, when the ASX was slowly coming down, he was on actually Ausbiz talking about how he is already getting in cash. Oh, there's a slide there. So the 8th of September, he was on national television talking about the markets, bringing a lot of our positions, selling half, also holding. So Angus is actually in about 20 to 30% in cash, Roger. So again, no one's got a crystal ball, but we are very confident. Again, listeners, go into all these 10%ers. We're going to be buying quality stocks at the right time.
Yeah, that's it. Because we know that there is a bull market which is coming up, and that's what we're really putting this cash aside for. And you certainly don't want to miss that with not much cash level. So we encourage everyone, if you can get up to good levels of cash, what you're comfortable with, we encourage you to do so. The third point is avoiding speculative growth stocks. And as Chris said earlier, everyone likes to have 1,000% in a week, but that's really a high risk in this market. So we'd encourage everyone if you can. And final one is patience. Now, it might not be natural for everyone because quite a few of us, including me, are impatient sometimes. We all want something, not yesterday, not today, but in this market, we advise a lot of patience. Now, part of that is we are waiting with many of our stocks in the portfolio are currently on hold. You see the hedge, that's a hold. So we are waiting and waiting to turn these into buys, and we will when the time comes. So if you want to be part of that, you encourage you to join us. But income is something which also investors like. So if you're a sort of self-funded investor, you're retired or maybe semi-retired, you're looking for good quality income dividend stocks, well, we have an income portfolio which we update once a quarter. Now, if we give you a quick snapshot of this portfolio, you will notice that this portfolio has been performing at 13.7% annual returns for the last 11 years on the ASX. Now, I might say that one more time, but before I do that, let me ask you a question. If you are looking for dividends and you're looking for reasonably conservative investment, what return would you settle for? If you're looking at top 200 ASX companies, would you settle for 8 to 10% returns per year, including dividends? Would you target 10 to 12% a year? If you can get that, would you be happy with that? Well, try 13.7%, and that's been running for 11 years running. How would that reflect in your portfolio? So on $1 million portfolio, that's $137,000 a year as a combination of dividends and growth. So Chris, this is one of our preferred parts of our service, which our self-funded retirees or self-funded investors like. Can you tell us a bit more about the dividends?
Yeah, and listeners, just so you know, a lot of our members are looking for defensive growth stocks with an income. So we're just showing a few stocks, not everything. So we've got the financial stocks, the industrials, property. But one I'll just highlight because we do have it showing is Nine Entertainment. So we actually first got in at $1. They're around the $2. They went to $3, listeners. So we actually sold. This is within 2 years. They went from $1 to $3. We sold half. They're around $2 at the moment. We've just got them on hold at the moment. But listeners, they own all of Stan, the movie channel, a bit like Netflix in America. They own 60% of Domain Property website. They're increasing their digital online agency. But the last column there, it says fully franked. So Nine Entertainment, you or everyone here, the 300 plus know who Nine Entertainment are, paying over a 6% fully franked dividend at $2 a share. Again, we've got them on hold at the moment. So again, we're not just telling our members Telstra, BHP, banks. We're identifying what stocks are very cheap. We're also given a very good income.
Yeah, that's the key. Thank you, Chris. And look, this portfolio shows you net yield per stock for financial year 23, financial year 22, gross yield including franking credits, and which stocks are fully franked, unfranked. And really the portfolio average of 6.5% for next year, 6.2% for this year, that's what we all like to have. So just have a think about that versus what you're receiving. Now, finally, it also, as part of Fat Profit's research service, we have made several changes to the subscription this year, and one of them is we send a daily email to the market about market events, and this is an example of the key topics discussed in each email, the highlights. So that's one of the things we have made some changes to. The other thing is now we do 2 webinars per week for our members, and I don't know of any other service in the market which does 2 webinars per week. And the first webinar we do is on a Thursday at 12 p.m. Sydney time. That's a macro webinar with our CEO, Angus Geddes. And Angus comes along for half an hour every Thursday to talk about all the big picture, what's moving the markets, Australia, US, inflation, interest rates, whatever is moving. He'll provide a view, he'll provide some recommendations, and he will also advise what he's doing as a fund manager, whether he's sitting in cash or he's investing. So that is a very valuable webinar every Thursday. And the second webinar we do is Monday at 12 p.m. That covers research team, all our analysts. They talk about 10 stocks every Monday. So these 10 stocks are buy, sell, or hold. They explain it, they answer any questions you have. And both webinars are live, they are interactive, and they are recorded. So if you're busy, you can replay them later. And we find that that's pretty much the jewel in our crown. It's the best part of our service is these live webinars. The other thing is our panelists. So of course we have a lot of people who work behind the scenes. They come and show their faces, they talk in the webinars. So you can see Angus right at the top, our CEO. I'm sure you've seen him on TV. Patrick, our CEO, he's been with the business for 20 years plus. David, our mining analyst, and he really is the guru for mining. Over 12 years with Fat Profits, that's myself. We've got Andre, Andrew, our analyst as well. Chris, of course, right here today, other senior account managers. So they show up and talk to our member base. The other benefit also we've made changes to is we provide daily updates on stocks in our portfolio. So if we see a stock that we're buying or we like, we will send you an email in the morning to say we're buying this stock today. Or if it's selling, we'll send you an email. If you're holding, there is an update, we'll send you an email. So every day we update a couple of stocks and we keep you informed right at your fingertips. So this is a fantastic change. But Chris, we also do alerts, midweek alerts. Tell us more.
Yeah, this is a very good feature that we've been continuing to upgrade. So sometimes, you know, when ones are coming on board, they ask, you know, I'm not always looking at the markets. I might miss an opportunity. You know, I've got a life outside looking at the screens. Well, we send out midweek alerts. So if the analysts feel a stock's going to go up or down or something's happened on that day specifically, Roger, we'll send out a midweek alert that will go straight to your smartphone or your emails. In fact, just last month in April, we sent out 8 different alerts for our members as to a stock has gone up. So just so they don't miss out, they can quickly log in and read the full report. But again, doesn't happen often. April was a great month, but again, we'll just keep our members up to date. And you know, even if you miss all the entire week, as you can see on your screen, we have a Friday Fat Wrap. So we really summarize what's happened globally and Australia, what's happened in the week with a Friday Fat Wrap. You know, at the end of the Friday afternoon, you can quickly read it. It only takes about 5 minutes, and at least you're up to date with the markets.
Yep, very good. We also provide technical analysis for some people who like their charts and they want to look at certain indicators like support and resistance and moving averages and what's a good time to enter or exit. We provide that as well with all our daily stock updates. And the final thing, look, if you ask yourself a question as an investor, is what's the one thing that you like help with? What's the one thing that you can do better? I'm sure the answer is that selling at the right time. And that's the one thing a lot of people struggle with. And we provide you not only when to buy, but also to sell. And here's a few stocks that we've sold in the last 12 months. Have a look at some names if you're familiar with Whitehaven Coal or any of the others like Sonic Healthcare. And you'll notice that our buy and sell prices, and if you'd invested $10,000 in any of these stocks, what type of returns you would have had. And you'll notice that yes, majority are in the green, majority have made money. Of course, Hub 24 takes the cake, $175,000. So that would have been very nice. But look, we don't get all of them right. There are a few losses, and look, it's bound to happen. Of course, when you invest in 50, 60, 100 stocks, you're going to have some losers, but we try to keep them to a minimum, and we get 7 out of 10 right. Now, moving forward and looking for opportunities, because that's all what we're here for today. Well, the key message is the bull market is coming. It's not here tomorrow, but it will come in the coming months. Are you prepared? Are you ready? Are you looking for some opportunities? Because every time the markets go up and then you see a bear market like we're seeing now, the bear market, of course, will come to an end at some point in time. And when it does, boy, there's going to be very good opportunities for a new bull market. And how does that reflect in history? Well, 36% rise is normally has happened in the 12 months following the end of a bear market. So once the market bottoms out, that's the huge jump. And you can very well imagine, if you actually get on the right side of this, imagine the returns. On a $1 million investment, you're looking at $360,000 in 1 year. And that's nothing to sneeze at. But even if you don't get the timing absolutely right, you're still looking at 20, 25, 27% returns, even if you get in 1 month early or too late. That's not a problem. So with that said, what we'd like to do is for you to consider having a look at your portfolio, look at your cash levels, look at how you position in different sectors, and do what we call is a portfolio health check. This is a very good time now in May for you to consider checking out your portfolio and readjusting if you haven't done it already. And we can help you with that as well. But Chris, before we provide some reasons for people to consider our service, yes, we have a lot of our members who posted reviews. We've got a 4.2 star rating, which is not too bad. And a lot of our members are quite happy with our service.
Yeah, I think, Roger, you and I are quite proud about this. So, yeah, you can go to this page, and as you can see there, the 349 reviews. Most of our members are very happy, don't please everyone, but the majority of our members, you know, if they follow when we say buy, if they hold when we say hold, if they sell when we advise to sell, you are going to perform with the service. I think David Campbell is one of your members, Roger, yes. But yeah, very happy members, and we're quite proud about that because it does change lives.
It does. It surely does. So give us a few points, because investing in your education, investing in research is really investing in your earnings. And we will encourage everyone watching this today is to have a quick look at what we're about to show you, because there's a few reasons why you should consider, and we've got a very good price for you to consider our service.
So if you're just looking at this page, these are the reasons why, Roger, people would want to come on board with us. So as you can see, the performance, we've got 16.7 over the last 22 years. We're entering our 23rd anniversary this year. We save time. So again, if you don't have the time or inclination to do it yourself, or you have the experience, you can use us. You still make the decision, but we're just giving you a bit of direction as to if, when, and why you should be getting into them. So the last 22 years, we've been getting 7 out of 10 right. So that is something we're very proud of. We're not a cross-marketing or upselling kind of company. So once you subscribe to us, you're getting the full benefits with our service. You're not going to pay more in 3 months' time. And Angus, as I said, we are managing real money, so over 200 million in the markets. We've got a bit in cash at the moment, but we actually are putting a lot of our money where our words are as well.
Yeah, very good, Chris. Look, the key thing is our performance. I think that really stands out. For me, look, we work very hard for our members, and we're very proud of 16.7%. Let's just call it 17%. Compare that to what you've achieved in the last 1 year, 5 years, 10 years, 20 years, and you will be surprised that, you know, that could make a significant difference if you can do it for a very long period. Do the maths, and I'm sure you'll find our service very, very cheap. Now, we're offering up to 50% off as an incentive. Some of you probably already keen to join our service, so we understand that. But here's a good incentive for you to consider our service. Now, keep it very simple. We have 3 levels of membership: a standard, a premium, and a platinum. Now, all 3 types will receive the 3 main benefits, which is the daily Fat Chat Market commentary email, You receive that email every morning before market opens. You will receive the 2 member-only webinars that we talked about earlier. Both are recorded, so not a problem. You can replay the recording, and you will get the Friday Fat Wrap, which is any highlights of the week you missed out on. The difference between the 3 is our 3 portfolios. So we have an Australian equities portfolio, which covers Australia and New Zealand, and that's got 55 to 60 stocks currently. So if you're looking for that, plus the dividend portfolio that we showed earlier, so both are in this. Second one is the global mining portfolio that has all mining stocks. So everything mining from junior miners like Chalice Mining or an Allcam, all the way up to BHP. So if you're looking at just mining stocks in Australia and overseas, that is a fantastic one. And the third portfolio is global equities. This covers all the international markets. This has about 80 to 90 stocks in US, UK, Europe, and Asia. So if you want one of these portfolios, then you can just become a standard member. Most people, though, become premium members because they want 2. They want Australian equities and mining, and they also get a premium account manager. Someone like Chris, who's a senior, been with the business for 12 years, Chris. So you can speak to someone like Chris or some of the others, and they can help you with any questions. If you want all the 3 portfolios and the account manager, then the Platinum service is the one for you. Now, as a one-off, what we're offering today is something very special. And before we get to the price, just want to highlight that we're offering a 30-day money-back guarantee. And that is a first. We've never done that before. But just to prove to you that you've got nothing to lose and everything to gain. Now, on top of that, of course, it's normally a tax deduction for most investors. But again, we can't guarantee that. You've got to speak to your accountant. But we will issue a tax invoice to your name or your super fund, and that's not an issue. Now, in terms of price, look, Chris, I'll let you take the lead because these prices are super cheap, less than a coffee a day.
Yeah, so again, as you can see there, what Roger said, you can invoice it out of your super fund. So a lot of our members do that. But the top fee there, so if you go to our website, our yearly fees are $13.95 for standard, $19.95 for premium, and $25.95 for the platinum. So again, we work on annual rates. Roger and I, we talk about annual rates when we work here. So if it's standard that you're looking for, which is just 1 report with no account manager, then for 2 years at $6.95, it's a bit of a steal, Roger. So you're paying the 1 year and you're getting it for 2 years. Again, if you want to go longer, a lot of our members have been with us for many years. You can get the 3-year membership only at $5.95 per year. A lot of our existing members, they are on the premium, so you can pay the 1 year fee and you're getting it for basically $9.99, so $1,000 a year, and you're getting all of our recommendations when it comes to the ASX and the mining. Again, better annual rate for $895 a year out of your super fund. You can get it for 3 years. And again, whether it's myself, Roger, or another senior here, you've got someone to talk to. We can have a chat with you. You know, hey, Chris, I've got this stock. I don't know what to do with it. What does your analyst say? We can come back with some feedback. But again, it's your money and your decision. We just give you some direction. Platinum is where you involve and include the global equities. So Europe, UK, America. We actually tell you exactly what to be doing globally. Again, that's a bit of a steal at the moment. I mean, the 3 year for $1,095 per year is a bit of a no-brainer. But you know, some members do want to look globally. Some members don't, Roger. So they go to the premium. But I'm sure by now you'll have an understanding as to which package you're looking at. And the best way to look at it is just that annual rate. That's what you'll be paying yearly.
Absolutely. So look, I'm going to put up this question here for you now, and here it is. So you can register your interest levels on either or. But while you're considering this as well, you know, have a think about, you know, how much money you probably have lost in the stock market making some bad decisions on buying and selling something bad without doing proper research. You know, you're probably looking at, I mean, most investors, including myself, I've made rookie mistakes in the past, lost tens of thousands of dollars, if not more, in bad decisions. So this is a very small investment. $800,000, $900,000 a year is nothing compared to what you probably already lost. But the opportunity to make a lot of money is right in front of us. The bull market is coming, and this is the best time for you to join our service. We're offering a 30-day money-back guarantee, nothing to worry about. all the pressure is on us. So we have to deliver, we have to provide you a service which really gives you value and ideas that you may never thought about. Never thought about Chalice Mining. You would have never thought about Whitehaven Coal or a Spark New Zealand or a Nine Entertainment. Just need to pick one of those stocks, a Gold Road Resources, just one stock, and you'll be laughing all the way to the bank.
Can I just make one point, Roger,
sure.
while we've got that there? That hidden gem, one of our high conviction buys, I mean, we've been talking about $10,000 on these investments. If you bought $10,000 in that hidden gem at 16 cents, we can see it going past 45 cents. Even if it just goes to 25 cents, Roger, your 10,000 is now 15,000. So you've already made your subscription fee back. So that's how we think here at Fat Profits.
Exactly. Good point there, Chris. So look, I'll take one quick question, just come through from, where are we? Here we are, Jeremy. So he's talking about another service. He's saying, I joined Motley Fool about 9 months ago. And he said, I've been bombarded by them asking me to sign up with other services. And they keep emailing very long emails asking me to pay more. If I join Fat Profits, one of these services, will I get the same treatment and constant bombarding of more products? So I'll answer that for you, Jeremy.
Yeah, you can answer that. Yeah, go for it.
So Jeremy, you look, that's one thing we are proud of. We don't have multiple products. What you've seen here today is all we have. So we've got the three portfolios: Australian equities, mining, and global equities. So if you pick one or two or three of them, that's it. There's nothing else. We'd love to sell you more, but we don't have any other products. So the good thing about our service is you get exactly what you pay for. You want research, you want us to talk about stocks, you want us to talk about markets. That's all we do, nothing else. So you can be rest assured, and I can put my house on it, you won't be emailed or bombarded with other products. We just don't have them. Okay, so hopefully that makes it a little bit easier for you. Thank you. And look, that brings us to the end of today's webinar. Hopefully you've learned something that you wanted to get out of the webinar. As you said at the start of this webinar, some of you wanted more market knowledge, some of you were looking for a new service, etc. So whatever you're looking for, hopefully we've been able to provide that. It does take a lot of time and effort to put this together, and hopefully that effort that we have put in is well received by you. If you decided to join our service, we thank you for keeping an open mind, and we'd love to help you in this bear market and help you make some money on the other side. On that note, I'll say goodbye. My name is Roger. Thanks for your company today, and we wish you all the best and talk to you soon. And I'll pass it on to Chris for his final words.
Yeah, nice to do it with you today, Roger. The webinar and all the attendees. We hope that you found it quite informative. Thanks for logging in.